Hey everyone, just want to let you know about our next boot camp coming up on August 24th. It's going to be on private placements, which is Rick's favorite topic and his personal specialty. We'll be going from 8 a.m. to 4 p.m. with a lot of content for you about private placements. We also have special guest Adrian Day joining us. He's the portfolio manager of the Schiff Gold Fund, and Matt Geiger, who's the portfolio manager of the MJG Capital Fund. That's August 24th for the private placement bootcamp. Link is in the description below. Hope you can join us. Now, what follows is a preview of some of the material we'll be covering. Hope you enjoy. Our topic today, Rick, is private placements, something of very keen interest to our audience. Maybe you could just start by introducing the difference between investing in the private sphere versus investing in the public sphere.
Yes, that's a good place to start. A private placement is an issuer transaction, which means that rather from buying the securities from a different investor after issuance, either over the counter or through securities markets, you are buying the privately placed issuance of either debt or equity directly from the company, directly from the company's treasury. There are other forms of private placement. Sometimes aftermarket investors have a large enough position that they in turn sell their securities by private placement. But for the purposes of the discussion that we're going to have today, we're going to define private placements as a non-issuer as an issuer transaction. The issuance of debt or equity directly from the treasury to investors, and one that doesn't involve a public offering document.
Okay. Why? I have questions that I can insert, or do you have a set agenda you'd like to follow?
I have a bit of an agenda, but you know me, I'm easily interruptible.
The follow-up question to that would be, why would a company want to do this, and why would investors want to participate?
Traditionally, private placements are quicker and cheaper than public offerings. Very often, a public offering will require an S-1 registration with the SEC that can take as much as 6 months to get approved, and can cause to occur as much as $250,000 in additional expense. So the time and trouble involved in many forms of public issuances cause companies to do things privately. The private placement investor, by turn, is often offered better terms in a private placement than would occur in a public offering, because of the ease to the issuer, and also because of the lower cost. So from the point of view, I guess, of both, the issuer non-public transaction is more efficient and quicker, and therefore potentially of benefit both to the buyer and to the seller. I think, Albert, for today's discussion too, we should differentiate between various forms of private placements. So-called private issuers, which are private companies that may or may not stay private. Pre-public, which are private issuers, but issuers that intend to go public. IPO and aftermarket, or PIPE investments. PIPE being private investment in public equities. So let's talk about these. Almost by definition, private companies that go to raise capital will raise that capital by a private placement because they're private. There is no aftermarket transaction to facilitate. And most of the so-called private equity transactions that are so popular in the United States involve the private placement of privately placed equity in private companies. For our purposes, we're not going to talk about that very much. One of the rages for the last 15 years in good equity markets has been pre-public. The idea that you can buy stock in a private company which intends to go public and avail yourself of the lift in price on the initial public offering. The great success is an example of tech IPOs in the last 40 years has spawned an enormous industry in gray market and pre-public equity issuances by aspiring tech companies that at least announce their intent to go public. Billions of dollars have been made, and by the way, billions of dollars have been lost in pre-IPO speculation, not just in technology. I've managed to do well and poorly both in pre-IPO natural resource issuers. Then, of course, there is the IPO, the initial public offering. By definition, not a private offering, but private offerings sometimes occur in tandem. It is important that listeners to this understand that IPO is very often an acronym for "it's probably overpriced." Companies go public when windows open, and windows often open around narratives where the industry is already in vogue. Understand that anytime a company issues equity, they are suggesting that the money that they receive is more valuable to them than the piece of the business that they're giving up. And so it's important to understand that real truism around any form of offering investment. The company is saying to you that the money is to them more valuable than the shares, and they likely know more about the value than you do. And then the last are PIPE, or private investment in public equity, which is most of what we're going to talk about today. In this circumstance, the company is already public and they require expansion capital or survival capital, some type of capital, which is propitious, to offer to the investing public by way of a private rather than a public offering. It's important, too, I think, to describe some of the limitations around private placement investing. The first is that by statute, in both the United States and Canada, investors in private placements are restricted, which is to say that they need to be described as accredited investor. The most common definition of accredited is $1 million net worth, excluding home furnishings and fixtures, or $250,000 in income in the preceding 2 years, and the probability of $250,000 of income in the current year, or both. So it's important to note that for some of the people who may listen to this broadcast, as a consequence of legislation, that they will not be allowed to participate in private placements. The exception would be in Canada, where close friends and business associates are often included in private placements, or in the United States, whereby there are some exemptions that exist on a state-by-state basis for the inclusion of up to 35 non-accredited investors in a private placement. But for the most part, what we are going to talk about today are PIPE placements, private investment in public equities, to accredited retail investors. I hope that part's all clear. It's important that the audience knows who and what it is. And I think that we're going to deal, again, in two different types of placements. Debt placements, which I'll cover briefly, and equity placements, which I'll cover somewhat more broadly, because I think the existing listener base that we have is more skewed to equity private placements, and equity private placements are certainly much more available than debt placements. That being said, let's talk about debt placements first. Debt placements commonly take place in four broad categories: bridge financing, mezzanine financing, project financing, and working capital financing. Bridge financing is not, as it suggests, money that's being made to construct a bridge, but rather money that is being contributed to the company to bridge a need. It might be that companies need to finish off a feasibility study, and they think that the receipt of the feasibility study will give them enough market exposure that the share price will rise and they will be able to raise equity more cheaply. So the money that would come in a bridge financing would be to meet a short-term gap in financing needs, with the belief that this debt was cheaper than other forms of financing. Mezzanine financing suggests that it's not the senior secured, which is to say the security around this financing is subordinated or junior, like the mezzanine would be the second floor of the building. In this analogy, the first floor would be the senior secured debt. The second floor would be the mezzanine debt. It means that your claim on the collateral is subordinated to other senior claimants. Project debt is the type of financing that, as an example, has from time to time sustained the dividend at our former employer, Sprott Inc. In this circumstance, a non-investment grade company that can't borrow on their own balance sheet will borrow using a project and a subordinated corporate guarantee to build a mining project. If the company needs to raise $1 billion, they might have to put up $350 or $400 million in equity, but they might be able to borrow in senior project debt 65 or 70% of the construction budget of the project. And then there is, of course, the broad category other or working capital finance debt. There are circumstances where companies believe that their equity is undervalued enough that it is cheaper for them to operate part of their capital stack, operate part of the capital requirements of the company with debt rather than with equity. And privately placed debt almost always occurs as a consequence of the fact that the company that issues the debt is not of sufficient size and stature to be regarded by the big rating agencies as, quote, investment grade debt. This is classically the so-called junk debt, which is to say debt, although it may not be of bad quality, but debt that is non-rated, debt that, for the most part, isn't contributed by the senior chartered banks and isn't accessible through the investment grade bond market. This is a very, very large category. It's a category that I have participated in, and by this, I mean privately placed debt, is a category that I have invested in with very good results on balance over 35 years. It's important that speculators understand the truism that the worst piece of debt on any balance sheet is more secure than the best piece of equity, which is to say even the junior debt has a senior claim on the assets, including the working capital of the company, a claim that is senior to the equity holders. It is also true that every form of intelligently constructed debt offers dividends, offers a yield, which means that you recoup some of your capital along the way. And this recoupment of capital along the way, in fact, ultimately reduces your risk, which is to say if things go wrong, you lose some rather than all of your money. So let's talk something about the characteristics that an investor should look for in terms of privately placed debt. In the first instance, what is the money going to be used for? And is that use likely to add value and likely to add enough value on a timely basis that the company will be able to afford you both principal and interest back? Don't take their word for it. Consult the lessons that we've already taught in the Rule Investing classroom around unanswered questions and rudimentary securities analysis. This is an investment like any other kind, so study it. For the most part, in non-investment grade, in small companies, you want only to invest in senior secured debt. In other words, you want the debt issuance that you subscribe to be senior to all other claimants. You don't want to scramble for the money. You want to be in first place if things go wrong. It is important for investors to note that in both the United States and Canada, it is common for the employees and the officers and directors of the company to have wage claims that become senior even to the senior debt. And it is true as well that the government puts themselves in the pole position, which is to say unpaid taxes and fees are always senior to the claims of creditors. So when you are told that you are the senior claimant, understand that in most cases, there will be wage claims and tax claims that are superior to your own claim. So when you're doing an analysis of the ability of the company to pay back principal and interest, understand that you will always be, or almost always be, subordinated to the claim of employees and governments. It is important that American investors, too, understand the difference in liquidation between U.S. domiciled companies and Canadian domiciled companies. Canada is a receivership jurisdiction, so that when a company goes into bankruptcy, an independent receiver is appointed to liquidate the company for the benefit of stakeholders as described in pre-existing contracts. Which means that the estate is liquidated first for the benefit of the employees, prior claims are settled, then for the benefit of government agencies, and then for the benefit of other claim holders. In Canada, the senior claim holder gets paid before the junior claim holder gets paid. The United States is a bankruptcy jurisdiction where most commonly, when the company goes into bankruptcy, it continues to be administered by the same management team that put them in bankruptcy. And U.S. law reserves broad discretion to judges to liquidate or administer the claim for the benefit of all stakeholders as he or she sees fit. So as an example, in the bankruptcy of General Motors, where there were contractual stipulations on the part of the union in favor of the bondholders, when the company went into bankruptcy, the union sued in bankruptcy court and actually got the senior stipulation that they themselves had entered into obviated, so that the claims of the pension scheme that had contractually stipulated their own subordination were reinstated to be superior. What all of this goes to say is that for the most part, privately placed debt in Canada is legally more secure than privately placed debt in the United States. So we said that senior security is important, but your security needs to stay senior. So in this case, you need to look at the agreement and make sure that something called a negative pledge is in place. A negative pledge is where the issuer, the company, agrees that they will not put any other debt in place. In my case, when I'm negotiating a private placement, either senior or subordinated to me. If the company gets into trouble, I don't want them to be over leveraged, and I don't want there to be a dogfight for the assets. So in addition to being senior secured at the time that the obligation is entered into by the issuer, I insist on a negative pledge, which restricts the issuer from issuing any more debt, either senior to me, pari passu with me, or even subordinated to me without my agreement. I'm looking to specific security, which is to say I want to be registered against the asset that the debt is securing. And in addition to that, I want at least a limited recourse corporate guarantee. If they tell me they're going to pay me back, I want them to show me how, and I want them to secure my interest in the assets and activities which are required to pay me back, both by way of principal and interest. It's useful at this juncture, after we've described the variety of stipulations that you need, that we talk about how you get paid. There are four basic tenets of privately placed debt that talk to your compensation for entering into the placement. These are respectively the bump. The bump is the upfront fee, if any, that you might obtain or require from issuing the money. It's very common if you lend somebody $200 million in a project financing that you sign the contract for $200 million, but you only actually deliver to them, say, $190 million. this $10 million up front is called the original issue discount. And it increases the size of the compensation to the lender in a way that isn't contingent on interest payments. In other circumstances where there is no original issue discount, it might be that the issuer issues as incentive stock, as an example, in the company, or some form of loan fee. At any rate, the so-called upfront fees, which get paid at closing, are referred to in the industry parlance as the bump, the benefit that you get for extending the money. The most common form of payment, of course, is the coupon or the interest. There are two forms of interest which are commonly paid. In one case, the interest accrues, which is to say that the borrower acknowledges the interest payment, but the payment itself is added back to principal and paid over time. I prefer my interest payments to occur as opposed to accrue, which is to say I want to receive quarterly or annually or annual cash payments. I want this to happen for really three reasons. One, I simply like cash. I like getting the income from this, and I like reinvesting the income from this to diversify my portfolio. The second thing, of course, is that receiving this income by way of interest lowers my total exposure and hence my total risk to the loan. Having it all back-ended by way of accrued interest increases rather than reduces my risk. But the third is that the best form of communication, from my point of view, between a borrower and a lender is a check. The fact that they are able to distribute money to me on a periodic basis is to me very, very, very comforting. I have had occasions where good issuers have run into difficulties, and the good issuers tell me ahead of time, you know, I feel pretty good about the interest payment that's coming up in, say, June, but I feel much less good about the interest coming up in September. And so we need to begin to negotiate now. In this circumstance, that coupon was a simple form of communication between a borrower and a lender. The next source of benefit to the lender from the issuer is what's called in the industry the KISS. In almost every circumstance, the equity holder, the shareholder, is getting the increase in value attributable to the capital that was raised in the private debt placement, which is to say the company is issuing the debt because they believe it's cheaper than equity, and they believe that they will be able to generate more value from the money that they received than they had to pay for that value. And it is common for the debt holder to receive a little bit of contingent special compensation in addition to the loan. It might be a royalty on the asset being built. It might be a redeemable royalty. It might be warrants in the issuer. It might be a synthetic form of payment tied to commodity prices or tied to free cash flow. But at any rate, in addition to the upfront fee and the coupon, there is very often a KISS. And then finally, of course, in privately placed debt, and I've made a lot of money from this, are restructuring fees. Often, despite everyone's best effort, the companies don't make the improvements that they had intended to make with the money that they borrowed as rapidly as they would like, or the payoff doesn't come as rapidly. And often, despite the best efforts of everyone involved, the loan needs to be restructured. This has been very common in my life. And whenever I am structuring a loan, I try to structure in a circumstance that avoids default, that extends and changes the term of the loan. But I always do it in return for a fee. An example, Albert, might be that the entrepreneur, the issuer, and by the way, they're always optimistic, they might say, you know what, Rick, I only need this money for a year. And I'll say, well, that's great. But what you should probably do is you should borrow it from me for a year with an automatic 1-year extension if you're not in default. The reason for that is if you borrow the money from me for 2 years, as opposed to for 1 year, it goes on your balance sheet as a long-term rather than a current liability. It makes your balance sheet look better. And you should do it for that reason. The second reason is, although we have it printed for 2 years, if you only need it for 1 year, you are better off not paying the higher charges that would likely accrue to you from having the availability for 2 years. Now, the way we'll structure this loan is that for 1 year, you will pay me the total compensation for the year of, say, 12%. If you roll it over, and you're able to roll it over if you're not in default, the interest rate will go from 12% to 14% or 15%, or you'll pay me a rollover fee. So these restructuring fees can be built in at the beginning of the agreement, which anticipate difficulties, and they anticipate what the outcome to the difficulty will be for the benefit both of the lender and of the creditor. So to remember this, we're talking about a bump, we're talking about a coupon, we're talking about a KISS, and we're talking about restructuring fees. And it's important when people consider debt private placements that they consider all four and look for all four means of compensation. Let's move on now, if we can, to equity private placements. And remember that for our purposes, this discussion means primarily PIPEs, which is to say private investments in public equities. These companies are already public and are coming to the market because they need the money and they believe that they can generate a higher return with the money than without the money. Let's begin with describing the risk. In every circumstance where a company is issuing shares to raise money, they're doing it because they value the money more than they value the shares. So you're going to have to look at the value proposition. You are going to have to determine roughly, using the lessons from the Rule Classroom, roughly what you think the equity is worth relative to what you're being charged for it. You're going to have to consider, too, the use of capital. Will the use of capital actually demonstrate the accretion of value that the management believes it will over the time frame that they describe? That's a long-winded way of saying, is this a good investment? The processes to determine this are the same as the processes used to determine whether it's a good investment in the aftermarket. Valuation and the discrepancy between price and value never change. So let's look at what investors need to do after they've done the security analysis to determine whether a private placement is a good equity investment. The first thing is the discount. Private placements generally occur at a discount to market. This discount in the United States and Canada is often warranted by virtue of the fact that the privately placed securities have a hold period, which is to say that although normal common shareholders can buy and sell their stock all day, every day, the private placement holder is restricted by a restricted legend on the security from accessing retail markets in Canada for 4 months or in the United States for a year. So very often these retail restrictions generate a discount. The discount can, by statute in the United States, be as large as is described in the document and approved by shareholders. In Canada, there are statutes where generally small companies can issue shares at as much as a 25% discount to the then prevailing market. So the first thing that investors must do is look at the discount offered on the security to market, not just on the day it's issued, but rather over the 20 or 30 preceding trading days, so that you get a sense for what the sustained market was, what the sustained aftermarket price of the security, and what price you are paying for the security. For me, the most important facet of a private placement is the warrant. A warrant being the right but not the obligation to buy more stock at a fixed price later. If you are truly offering up in a private placement what is catalytic capital, If you are offering up the money that will cause the answer of some answered question to the great benefit of existing shareholders, it makes sense that you should benefit to some extra degree too. A warrant is the ability over some period of time to buy additional stock for a fixed price. It's important in considering the warrant that you look at the timing of the warrant. If, as an example, the money that you're contributing will answer an unanswered question, but the unanswered question will take 2 years to answer, and you only have a 1-year warrant, it's the same as having no warrant at all, because you won't benefit from the answering of the unanswered question. So it's very important that the time restriction on the warrant be consistent with the time required to answer the unanswered question that your capital contribution caused to be answered. If I'm offered a private placement with no warrant, and I'm not offered a very, very, very large discount to market, unless I consider the company to be grievously undervalued, I have absolutely no incentive personally to subscribe for that private placement. I subscribe to private placements because I believe that my money has the probability of answering an unanswered question, that there is a good chance that the answer will be profitable, and where both the share price and, to me, the warrant appreciation give me the ability to be fairly compensated for the time risk that I have taken and the capital risk that I have put up. The third thing that investors need to look at in almost every case is the restricted legend. You are offered up in most jurisdictions securities that aren't free to trade. And here there are some important distinctions. Investors who invest in British companies or Australian companies, if they structure the investment correctly, can resell those investments in those markets, Great Britain or Australia, usually the next trading day. It is not uncommon for Australian and British issuers to put a U.S. restrictive legend, which says that investors in the United States will be bound by American securities laws. And if you attempt to sell an Australian or a British security in the U.S. before the restrictive law legend applies, your certificate will not be good delivery. You will have to have the ability to resell that Australian or British security in their domestic markets. In Canada, Canadian private placements are restricted for Canadians for 4 months. But again, they are restricted for U.S. holders for the lesser of 4 months if you sell the stock in Canada, or 12 months if you sell in the U.S. It's important that listeners to this discussion, American investors who invest in Canadian securities, insist on language in the restriction provisions in the offering memorandum of will sell rather than have sold positions. What this means is that you agree that you will sell the security and you will sell it through a Canadian exchange, and you will not knowingly resell the security to a U.S. buyer. Have sold means that you warrant that you have sold it or will sell it, and you know for certain that you haven't sold it to a U.S. person. But if you sell the security through the facility of the Toronto Stock Exchange, there's absolutely no way that you can make that representation. And the clearing firm and the brokerage firm will again, without proper documentation, refuse to accept that security for good delivery. So make sure, if you're an American subscribing for Canadian private placements, that the restrictive legend have will sell rather than have sold provisions. Now, let's talk again in a very broad sense, but only briefly, about the nature of private placement investing. The first thing is simply value versus price. What are you paying for the securities, and what are the securities likely worth? I'm not trying to say that a private placement should give you dollar bills for dimes. I'm not saying that you should necessarily buy them at huge discounts to intrinsic, or that you shouldn't buy them at a premium to intrinsic. I'm only suggesting that you know enough about the value of the company that you're buying, that you have some sense of whether the price is a realistic or an unrealistic, an attractive or an unattractive price. Understand that in every case, this addition of capital occurs because the company thinks that the cash is worth more than the shares. They think that because they believe that with this infusion of capital, that they will be able to make the whole company more valuable. And in almost every case, this involves the answering of an unanswered question. When considering a private placement investment, either debt or equity, ask the management team, what unanswered question, what process, what asset is going to change the value of the investment? This is the crux of not what the valuation is today, but what the intended valuation is over the course of the investment. It's really important that you understand this. And it's important that you understand time frames too. It's important that your orientation as an investor conforms with reality. If you're the type of investor that has trauma holding stock over a long weekend, and the answer to the unanswered question will likely occur over 2 years, if you don't change your time frames with regards to how the answering of the unanswered question will impact the market response and hence the share price, you run the risk yourself of being an investment risk. If you have a 6-week time frame anticipating what is in effect a 2-year outcome, you're the wrong investor for this private placement. So it's important that you understand the difference between value and price. It's important that you understand something about what the unanswered question is. It's important that you develop an opinion as to the probable outcomes. In other words, how likely are these companies to get a yes answer to an unanswered question? And it's important that your time frame with regards to the investment corresponds with reality. We could deal with the private placement topic forever, Albert, and I hope we generate a lot of questions at some later date that we'll answer. But 2 things, maybe 3 things I'd like to suggest. The first is that for people listening to this broadcast, they can sign up, should they want, to a private placement database maintained by Rule Investment Media. If you go to the rankings database at Rule Investment Media and in the question and comments section, write in placements, we will add you to the private placement database. In that circumstance, where there are appropriate private placements, either debt or equity, that I participate in, I will give you notification of what I'm doing and why I'm doing it. There's no guarantee because I got in that you'll get in, but you will know what I'm doing, why I'm doing it, and I will give you company and or broker contacts to facilitate your access to this. These are not investment recommendations. This is just simply notification of what I'm doing with my own money. I don't charge investors for this yet. It may become a subscription product someday. And I don't charge the companies. This is just something I do. So go to Rule Investment Media, rankings, and in the question and comments section, write placements. The other thing that occurs to me, Albert, is that many of the people listening to this broadcast will be people who attend the Rule Investment Media boot camps that you and I put on. If people are interested enough in the subject of private placements, if people have listened to this whole discussion that we've had today, it might be that they'd like us to put on a private placement boot camp, an 8 or 8.5 hour online symposium going deeply into the weeds in private placements. If that's the case, I would ask them simply to indicate to us that they think that private placements would be a good subject for a boot camp, that they would like to invest 99 of their dollars and 8.5 hours of their life to a really deep dive discussion of private placements. typified by the type of information that they received at the uranium boot camp, the silver boot camp, or more recent battery metals boot camp. I don't know if you think that's a good idea, Albert. I probably should have cleared that with you before I offered it, but I think it would tell us.
Floodgates. Yeah, Rick,
Pardon me?
I think you've opened the floodgates. I think there's going to be a very positive response to that offer.
Well, I think it would be an interesting boot camp to structure, and I think it would be useful to accredited investors if they want to do it. But of course, the subject of boot camps is always what the market wants, not necessarily what you and I find interesting.
Right. No, I would attend that one if I didn't have to work. Rick, we're running out of time, but I have a couple questions, and then we'll field more questions in the classroom for you at a later date. But first of all, you said you've had success doing private debt investments. Can you quantify what is a good return? Because this is not distressed lending, right? Where the returns can match equity returns. What kind of returns are good on this type of investment?
You know, Albert, if you take me back 30 years to the early days of the Vancouver Stock Exchange, there were occasions where my returns were constrained by usury laws, which is to say 59% annual interest. I long for those days, but they were generally for such small dollar amounts that I wouldn't any longer in my dotage make them. But I generally look for a minimum of a 15% annualized internal rate of return on these type of placements. My favorite sort of structure would be some small form of original issue discount or fee. I normally look for most of my compensation to occur in the form of a coupon. My favorite coupon, Albert, is 1% a month, which is 12.66% a year. And as I say, I like that interest to occur rather than accrue. 1%, because it's easy to understand. If we loan somebody $10 million, they got to give us 1% of $10 million, which is to say $100,000 a month. It also makes my favorite month of the year February, where I get my 1% in 28 days rather than 31 days. And then, of course, that other form of payment called a KISS. I like to structure money for the answering of unanswered questions in a way that gives me a little tiny piece of the upside, a warrant, a synthetic warrant against, say, commodity price increases or something like that. And of course, I always try to structure in my private placements to include restructuring fees. So commonly in the debt placements, I am looking at what I consider to be a floor yield of 15%, with total yields on a portfolio basis being a bit higher because of the variability of the KISS compensation and restructuring fees.
Rick, in the days where you were making those ridiculous returns, was it restructuring that was doing it? Is that the component that was putting it that high?
Very often in the early 90s, the equity prices of the issuers were so stupidly low relative to the value of their assets that these companies were literally selling for a third of their liquidation value. And the consequence to them was that the equity dilution that they would suffer to raise the capital necessary to answer unanswered questions was so extraordinary, and the market for equity so non-existent, that for small loans, I could charge fairly high rates of interest. Now, this rate of interest would almost always accrue to me by way of KISSes, which is to say I wasn't charging these guys 60% a year in simple interest. I would be charging them in those days probably 18% rather than 12% by way of coupons, but I would get very large warrant coverage or some very large form of synthetic equity in the project, which was then redeemable when the loan was repaid.
Okay, so that's almost ideal, right? Making your floor return on the coupon and getting your upside with a KISS.
This only occurs, of course, in very bad markets where most people don't have the courage to make the loans.
Yeah, right.
It's
Okay.
odd that your returns are almost always higher when the psychological cost of making the loan is also at its highest.
Question about getting paid.
Yeah.
So we've talked about the long life cycles of these projects and how long you have to wait actually to cash flow. When you're making a bridge loan, it's very clear how you're going to get repaid. But say it's not that, and even if the loan you're making is catalytic, it's not something that's going to result in cash flow. In that case, are you relying on a future equity raise to get paid? How are you getting paid? Or rolling over the loan? How are you getting paid?
What normally happens in, let's say, a successful project loan is that you have lent them the money to complete the project and probably to operate the project for 3 or 4 months after the project has been built. It is true that if they make you cash payments, cash interest payments during the life of the loan, that they are funding those cash payments from other than operating cash flow, which is to say, in effect, you are lending them the money to pay you back. That's very much true. What generally happens is that once a project is up and running, the equity markets are buoyant enough that the companies don't need to pay you back out of operating cash flow, but rather they can refinance you out of equity. In fact, as a lender to sub-investment grade companies, your most frequent form of repayment will be an equity raise. In my earlier incarnations as a lender, what would frequently happen is that there would be a company that would own 2 or 3 assets, and they were going to buy a complementary asset to add to the mix. They believed that when the news of the new acquisition hit the market, particularly if there were synergies between that asset and other assets that they owned, that the market reception to this news would be positive enough that it would lower their cost of capital, which is to say their share price would go up and they'd suffer less equity dilution, and they would finance me out in that circumstance.
Rick, I want to alert people to the boot camp that we are hosting next month. And this is an exciting one for me, Rick, because it focuses on one of your specific areas of expertise, and that is private placements. So can you just give people a little bit of an idea of what you're going to be covering? These boot camps are pretty extensive. We bring in keynote speakers from all over the industry, but this particular one is going to feature the one and only Rick Rule, which is nice.
Private placements, it's a topic that fascinates me because I've done very well with it. It's also a topic that I'm well placed to teach because I've been very actively involved in private placements and creatively involved in private placements for 50 years. I believe I have a durable competitive advantage in private placements. We're going to talk about parts of the private placement business that other people don't talk about. In particular, debt placements and convertible preferred placements, which I think will be very, very important components of the market, and also private credit over the next 5 years. I would urge people who are either accredited investors, meaning portfolios valued in excess of $1 million, or aspiring accredited investors to pay attention to the boot camp. For those of you who aren't, the information that you see there will be more educational because you won't be able to employ it. Usually there are requirements in terms of participating in private placements that you have $1 million net worth. There is an exclusion for Canadians, so Canadian viewers who want to use the close friend and business associate exemption or the knowledgeable investor exemption can get benefit out of it. But for U.S. persons in particular, immediate utilization of the boot camp is probably limited to those with portfolios worth in excess of $1 million, or people with 2 years of annual income in excess of $250,000 and the reasonable expectation that that continues.
Your knowledge of the law is impressive, Rick, in addition to everything else. You have to cram in your head. The knowledge of these regulations is impressive. So this is going to be one for the intellectual bank account, as Rick said, but well worthwhile because this is an area that, I mean, all these topics, but this one I feel is like the information is not very easily accessible elsewhere.
I don't think this information is accessible easily or not easily anywhere else.
Right.
It's taken me now, Albert, 50 years to get this knowledge.
Yeah.
Some of the techniques that will be described, I literally invented as a consequence of running into problems that were unsolvable with the then existing structures. If I had to think about an area where I truly have a durable competitive advantage over most other people in the market, this is it.